Did you know that someone can potentially fund up to $83,250 into their 401k plan here in 2026? In today's episode of Cup of Bull, we are going to break down the Mega Backdoor Roth 401k and the ability to super fund your employer retirement account. My name is Michael Dunham. I'm the Director of Planning here at Fontana Financial Planning. Welcome to Cup of Bull. Cheers. So as I mentioned in the introduction, today's video, we're going to break down what's called the Mega Backdoor Roth 401k. And we're going to go over a couple things today. The first is, are you able to do a Mega Backdoor Roth 401k? And so in order to answer that question, typically what you want to do is you want to log into your 401k plan and you want to look for a document that's called the Summary Plan Description. That's the document that goes over the rules of your plan. Your plan has to allow for a certain type of contribution and what's called a Roth in-plan conversion or a rollover where you can complete a conversion in order to be able to properly complete the Mega Backdoor Roth 401k. So within that plan description, you will look to see if your plan allows for what are called after-tax contributions. Now, one thing I'll point out, it's commonly confused, but after-tax contributions are not the same thing as Roth contributions. Roth contributions, you receive no tax deduction for the money that goes in, but the growth of that money is tax-free forever as long as certain rules are met, like waiting until age 59 and a half. With an after-tax contribution, the way that it works is you get no deduction for the money that is put in. So if you make a $10,000 after-tax contribution, for example, you get no deduction for the $10,000 that goes in, but the growth of that money becomes pre-tax, meaning if you put $10,000 of after-tax contributions into your plan and those contributions grow to be worth $50,000 and then you take that money out, you do not get the $50,000 tax-free, even if you've waited until 59 and a half and met any sort of 5-year aging requirement. You receive the $10,000 that you've already paid taxes on tax-free. The other $40,000 you would owe income taxes on. And so the tax treatment of these after-tax contributions is not great. The only reason, in my opinion, that somebody would ever want to make an after-tax contribution is if it gave them the ability to do what we're talking about today, which is the Mega Backdoor Roth 401k. The other thing that you're going to be looking for inside of the plan description is the ability to convert those funds after making the contribution. So the most common way that this is done is by completing what's called a Roth in-plan conversion. Some administrators require that you jump through some sort of hoop, like calling in and making a request anytime you want to do this. Some have gotten better where they'll actually allow you to set up to automatically have these after-tax contributions converted to Roth. But by completing a Roth in-plan conversion of the funds, that gives them the tax-free growth that a Roth contribution receives directly. One thing to know about that is if you do have to manually call in or do something to convert the after-tax money to Roth, you may be subject to income taxes on any growth, if any has occurred. So for example, if you put $10,000 of after-tax contributions into the plan, before you made the in-plan conversion, that $10,000 grew to $11,000. The $1,000 of growth you will owe income taxes on when you complete the $11,000 Roth in-plan conversion of those funds. So now that we've talked about what to check for to see if it's possible to make an after-tax contribution and be able to do this Mega Backdoor Roth 401k strategy, let's talk through some of the numbers and how it all works. And so I'm going to explain what's called the 415 limit. So a lot of people are familiar with the contribution limit, which is how much can you contribute to your plan either as a pre-tax or a Roth contribution, which here in 2026, if you're under the age of 50, it's $24,500 that you can contribute. If you are over age 50, it's $32,500. So an extra $8,000 as a catch-up contribution. And then one thing that came into effect last year in 2025 was the ability to make what's called a super catch-up contribution. So if you turn age 60 to 63 this year, you can contribute an extra $11,250, bringing your contribution limit to $35,750. So a lot of people are familiar with those limits. What a lot of people are not familiar with is what's called the 415 limit, which is the maximum amount of money that can go into your 401k plan in a given year. And really that's a combination of three different things. So it's your contributions, either pre-tax or Roth, the employer match that you receive, which can be Roth, but generally is pre-tax. And then the third bucket of money that counts towards that is these after-tax contributions. And so you add up those three things and you can add up to the 415 limit as a combination there. So the 415 limit, if you're under the age of 50, is $72,000. If you're over the age of 50 but not eligible for the super catch-up contribution, it's $80,000. And then if you are eligible for the super catch-up contribution, is $83,250. And so that's the number that I alluded to there in the lead in. If you are of super catch-up contribution age, that is the amount of money that you can put into your 401k plan this year. And usually what it looks like is something like this. So you make your normal contribution, either pre-tax or Roth, up to the limit. So I'm just going to use over 50, but not super catch up for this example. So let's say you put in $32,500 as a pre-tax or a Roth contribution. And let's say that you also received an employer match totaling $17,500. So you contributed $32,500. You got a match of $17,500. That brings the total that's gone into the 401k plan to $50,000. So we know the 415 limit is $80,000. What that means is if we have the ability to make an after-tax contribution and we have the ability, ideally right away, to do a Roth in-plan conversion of those after-tax funds, we could set up an additional deferral from our paychecks of $30,000 and still be at or below that 415 limit of $80,000. And as long as we make sure that the in-plan conversion feature has been set up or we're manually doing it, that $30,000 turns into Roth money and can grow tax-free forever. And that's in addition potentially to the $32,500 contribution that this individual was eligible to make could have also been Roth, meaning in this hypothetical example, we had a total of $62,500 that will receive Roth treatment from one single year. So if you think about that, that's pretty powerful. I know not a lot of people are in a financial position to be able to save that much money, but for high earners who are in, I'll say, plans that have this sort of eligibility, it can be an extremely powerful thing, especially if you think about the ability to do this over a number of years and really create a significant amount of tax-free wealth. If you're married and both spouses have access to a plan that allows for this, that number becomes potentially double. And also, if you have no IRA money, this does not preclude you from being able to do the more commonly known backdoor Roth contribution, which for individuals age 50 and older is $8,600 per person here in 2026. So when we add up 8,600 potentially times two, 80,000 potentially times two. Now, some of that may be pre-tax employer match money, but we are potentially talking about pretty significant, 170,000 plus dollars that somebody could potentially defer, a married couple, into Roth tax-free money in a single year. So again, things to know for the Mega Backdoor Roth. One, you need to make sure that your plan allows for both after-tax contributions as well as the ability to convert those funds to Roth, typically in the form of a Roth in-plan conversion. And then the 415 limit, which is the most amount of money that can go into a 401k plan in an individual year, is comprised of three things: your normal contributions, either pre-tax or Roth, employer match, and then the difference is what you can fund as an after-tax contribution into your 401k plan for this year. I hope you found this video helpful and informative. If you did, please feel free to click the subscribe button down below and check in for more great financial planning content. If you are an individual that might have the ability to make these Mega Backdoor Roth contributions and you'd like to talk further about your situation and whether it may make sense, we also have a link down below in the show notes where you can schedule a time to speak with a member of our team, where we're happy to talk about your situation and whether this strategy may make sense. That said, again, my name is Michael Dunham. I'm the Director of Planning here at Fontana Financial Planning. I appreciate you tuning in for today's episode of Cuppable. And since I'm doing a solo episode today, I will wrap us up by signing off and saying, rebalance until rich. Cheers.